Level 1. Structuring. You've got $18,000 in cash sitting in a duffel bag, and the first rule you learn is the dumbest sounding one. Never deposit more than $9,900 at once. Banks are required to file a currency transaction report on any cash deposit over $10,000. It's automatic. No suspicion required, just a form that goes straight into a federal database the moment the teller processes it. So you split the $18,000 into two deposits at two different branches on two different days. This is called structuring, and on its own, it's already a federal crime. Not because of where the money came from, but because deliberately breaking up deposits specifically to dodge the reporting threshold is illegal, regardless of the cash's origin. Here's what nobody tells you about this level. It's the easiest one to get caught at. Banks don't just watch for deposits over $10,000. They watch for patterns of deposits suspiciously clustered just under it. A teller who sees the same face making $9,800 deposits at two branches in the same week doesn't need a reporting threshold to get suspicious. She just needs a pattern that looks exactly like what it is. Banks are legally required to file a suspicious activity report whenever a transaction pattern looks designed to evade reporting requirements. That filing doesn't require proof the money is illegal, it just requires the pattern to look wrong, which structuring almost always does once it's repeated more than once or twice. Compliance software at most major banks now flags structuring patterns automatically, comparing deposit timing and amounts across branches in ways no single teller could ever track manually. Most small-time laundering ends here, one flagged suspicious activity report away from a federal financial crimes referral. The money is technically in a bank account now. It is nowhere close to clean. Level 2. The cash business. You buy a laundromat not because you like laundry, but because a laundromat is one of the last honest cash businesses left in America, and cash businesses are the actual foundation of everything that follows. The method here is simple to describe and surprisingly hard to prove. You mix your dirty cash in with the laundromat's legitimate earnings before it ever reaches a bank. If the laundromat genuinely takes in $4,000 a month in quarters, you report $6,000 and the extra $2,000 in dirty cash rides along disguised as normal revenue. You pay taxes on the inflated number, which feels backwards until you realize paying extra tax on fake income is a small price for making illegal money legally taxed and legally deposited. This works because auditors can't easily disprove a cash business's revenue without extensive covert surveillance. Most agencies won't spend resources on unless something bigger is already suspected. A laundromat, a car wash, a vending machine route, a nail salon. These businesses exist specifically because they're plausible enough to explain cash nobody can trace back to a specific customer. The limitation is scale. You can only launder roughly as much as your business could plausibly have earned without drawing attention. Which means this method caps out fast if the amount of dirty money coming in starts to dwarf what a small storefront could ever legitimately generate. Investigators who specialize in this level of laundering often start with a simple comparison. Most launderers never think to check from the other direction. How much water, electricity, or detergent a laundromat actually purchases relative to the revenue it reports. A business claiming to wash $6,000 worth of laundry a month but buying supplies that would barely cover half that volume is exactly the kind of mismatch that turns a routine tax audit into a much larger financial crimes referral. Level 3. Shell companies and fake invoices. Once the laundromat can't absorb enough volume, you need companies that don't need to make sense to a customer walking in off the street because there is no street and there are no customers. A shell company exists on paper only, registered with a state, sometimes with an actual registered agent address that's really just a mailbox service. It exists to generate invoices for services that were never performed. Your shell company invoices your legitimate business for consulting fees or marketing services. The legitimate business pays the invoice. The money moves from a business that has to explain its income to one that never has to prove it did any real work, because on paper, it did. Layering, in laundering terminology, is exactly this: moving money through multiple transactions specifically to obscure its origin. Each transfer looks individually unremarkable, while the overall path becomes nearly impossible to trace without seeing every step at once. A single fake invoice looks like ordinary business spending. 20 of them moving through 6 different shell companies registered in 3 different states start looking like exactly what they are, but only if an investigator ever gets access to all 20 at the same time. This is where accountants and lawyers who specialize in laundering knowingly or with willful blindness become essential. Setting up a shell company correctly, with the right paperwork and the right jurisdiction, isn't something most people can improvise. It's a service, and services like this have their own quiet referral network among people who've already crossed this line. Investigators building a case against a shell company network typically start not with the invoices themselves, which are designed to look plausible in isolation, but with the registered agents and addresses tying multiple shell companies together. A dozen unrelated-seeming companies all using the same mailbox service, the same accountant, or the same formation agent is a pattern that survives even when every individual invoice looks clean on its own. That structural fingerprint, the connective tissue between entities rather than any single transaction, is usually what eventually turns a suspicious pattern into an actual prosecutable case. Level 4. Real estate. Real estate loves real money launderers for one specific reason. Property values are subjective, and subjective valuations are exactly the kind of gap dirty money slides through. You buy a rundown property for $200,000, paid partially in cash, structured to avoid reporting thresholds and partially through a mortgage from a compliant or complicit lender. A year later, you sell the same property to another shell company you control for $500,000. A price nobody can definitively prove is wrong, because property valuation isn't an exact science, and a market that's moved even slightly in your favor gives you all the cover you need. The $300,000 difference is now clean profit from a legitimate real estate transaction, at least on paper. Cash-only real estate purchases are a particular favorite because in many jurisdictions they've historically faced less scrutiny than financed purchases requiring a bank's own due diligence. Some countries and cities have started requiring beneficial ownership disclosure specifically to close this gap, rules requiring buyers to reveal the actual human being behind a shell company purchase. But enforcement varies enormously depending on where the property sits. This method scales beautifully. A single property flip can clean hundreds of thousands of dollars in one transaction. Repeating it across multiple properties, multiple cities, and multiple shell company buyers can clean millions without ever triggering the kind of cash deposit flags that catch launderers still stuck at level 1. Real estate agents and title companies occupy an uncomfortable position in this method because in many jurisdictions they face fewer anti-money laundering reporting obligations than banks do, despite handling transactions of comparable or greater size. Regulators in several countries have moved in recent years to close this gap, extending reporting requirements to real estate professionals specifically because the sector had become a visible weak point relative to the tighter scrutiny banks already faced. Where those rules haven't caught up yet, real estate remains one of the most reliable large-scale laundering methods available, precisely because the professionals facilitating the sale often have no legal obligation to ask the questions a bank teller would be required to ask about the same amount of cash. Level 5. Offshore structures. At this scale, domestic laundering methods start hitting a ceiling because domestic banks, domestic property records, and domestic tax authorities all share information with each other in ways that eventually connect dots you'd rather stay disconnected. The offshore method depends on jurisdictions specifically chosen for weak beneficial ownership disclosure requirements, places where you can register a company without the public record ever showing who actually owns it. Money moves into an offshore account held by a shell company, which is itself owned by a trust, which is itself administered by a local agent who has no legal obligation and often no practical ability to identify who's really behind the structure. Layering here often involves moving money through multiple offshore jurisdictions in sequence, an account in one country wiring to a company in a second, which pays a loan to a company in a third. Each hop adds a jurisdiction that has to individually agree to share information before investigators can see the whole chain. Some jurisdictions cooperate readily with international requests. Others require years of diplomatic and legal process before a single record gets released, if it ever does. International efforts to close this gap have accelerated significantly in the past 2 decades. Automatic information exchange agreements between tax authorities, increased pressure on historically secretive jurisdictions, and coordinated law enforcement task forces targeting specific offshore structures. But the method still works well enough in enough places that it remains one of the most durable tools in large-scale laundering. Precisely because closing every gap in every jurisdiction simultaneously has proven far harder than opening a new shell company in whichever jurisdiction hasn't closed its gap yet. Leaked document sets from major offshore service providers released publicly over the past decade through international journalism collaborations have repeatedly demonstrated just how routine this infrastructure had become before increased scrutiny arrived. Thousands of shell companies and trusts serving clients ranging from ordinary tax avoidance to serious criminal laundering, all processed through the same handful of formation agents using largely identical paperwork templates. Those leaks did more to expose the mechanics of offshore laundering than years of regulatory enforcement had managed on their own, simply because they showed investigators the entire client list at once instead of one suspicious transaction at a time. Level 6. Trade-based laundering. This is the method regulators consistently describe as the hardest to detect because it hides inside something that looks on paper exactly like ordinary international commerce. The technique relies on over-invoicing or under-invoicing goods crossing a border. Your company in one country ships a container of goods, furniture, electronics, textiles, anything with a plausible but genuinely difficult to verify market value to your company in another country. You invoice the shipment for far more than the goods are actually worth. The importing company pays the inflated invoice, and the difference between the real value and the invoiced value is now dirty money that's crossed a border disguised as a legitimate trade payment. Under-invoicing works the same way in reverse, shipping genuinely valuable goods but invoicing them for a fraction of their worth, letting the receiving company resell them at full value and pocket the laundered difference as legitimate sales revenue. Both versions depend on the same fundamental weakness. Customs agencies are built to catch smuggling and tariff evasion, not to independently verify whether an invoiced price for a shipping container of furniture is actually reasonable. Financial crime investigators estimate trade-based laundering moves an enormous volume of illicit funds globally every year, precisely because the paperwork required to catch it means comparing invoices, shipping manifests, and customs declarations across 2 or more countries' independent record systems, a level of cross-border document reconciliation that most customs agencies simply don't have the resources to perform on more than a small fraction of the shipments crossing their ports each day. Detecting this method usually depends on trade data analytics, comparing declared prices against a broader database of what similar goods typically sell for across thousands of similar shipments. A single invoice priced far outside a normal range doesn't automatically prove laundering. Legitimate businesses genuinely do occasionally pay unusual prices for unusual reasons. But a company that repeatedly, systematically prices its shipments at the extreme edge of plausibility across dozens or hundreds of transactions over years is showing exactly the kind of statistical pattern that eventually draws a customs fraud unit's attention, even when any single shipment might have passed unnoticed on its own. Level 7. Cryptocurrency mixing. By this level, you've moved from methods that mimic legitimate commerce to methods that exploit a financial system still catching up to the technology itself. Cryptocurrency mixing services, sometimes called tumblers, work by pooling cryptocurrency from many different sources and redistributing it, deliberately breaking the direct link between a specific deposit and a specific withdrawal that would otherwise be visible on a public blockchain ledger. Your dirty crypto goes in. A functionally equivalent amount mixed with everyone else's contributions comes back out to a new wallet address with no direct on-chain link to where it started. The blockchain, ironically, is both the tool that enables this and the reason it eventually fails for a lot of people who rely on it. Every transaction is permanently recorded and publicly visible, which means investigators with the right forensic tools, and increasingly sophisticated ones exist specifically for this purpose, can sometimes trace funds through a mixing service by analyzing timing patterns, transaction amounts, and clustering behavior across the mixer's entire pool, even when no single transaction reveals the connection on its own. Some mixing services have been seized and shut down entirely by international law enforcement operations, specifically because their own transaction logs, once obtained through a raid or a cooperating insider, retroactively unmixed years of transactions in a single stroke. The technology promises anonymity. In several major documented cases, that promise turned out to be temporary rather than permanent, lasting only until the specific service itself became a target. Beyond mixers, launderers at this level also exploit the gap between different cryptocurrency exchanges' compliance standards, moving funds from a heavily regulated exchange requiring full identity verification to one operating in a jurisdiction with minimal oversight, then converting back to cash through channels the destination exchange never adequately screens. Blockchain analytics firms have built entire businesses around mapping these cross-exchange movements for law enforcement clients, essentially reconstructing the same kind of connective pattern that catches shell company networks, just applied to wallet addresses and exchange accounts instead of registered businesses. Level 8. Correspondent banking and complicit institutions. At the largest scale, individual transactions barely matter anymore because the laundering happens inside the institutional relationships banks maintain with each other to move money internationally in the first place. Correspondent banking allows a bank in one country to process transactions on behalf of a bank in another country that doesn't have a direct relationship with the ultimate destination. This system, essential for legitimate global finance, has also been exploited in some of history's largest documented laundering cases, where a bank willing to look the other way, or simply undertrained to catch sophisticated patterns, processes billions of dollars in suspicious transactions over years before anyone catches the pattern. These cases typically unravel only when a whistleblower inside the institution comes forward, or when a regulator conducting a routine compliance review notices a volume of transactions that doesn't match the client's stated business at all. Some of the largest fines in financial history have been levied against major banks for exactly this kind of institutional failure. Not necessarily active conspiracy in every case, but a compliance culture porous enough that billions of dollars in obviously suspicious activity moved through the system for years without triggering the reviews that should have caught it much earlier. The mechanics of these failures are often more mundane than people expect. It's rarely a single executive knowingly approving criminal transactions. More often, it's an under-resourced compliance department processing thousands of alerts a day, a bonus structure that rewards processing volume over flagging suspicious activity, and a correspondent relationship deemed too profitable or too politically sensitive to properly scrutinize until outside pressure forces the issue. The largest laundering scandals in banking history tend to look from the inside less like a conspiracy and more like a slow institutional failure to ask an obvious question at any of the dozens of points where someone could have asked it. Level 9. The people who actually crack it open. Behind almost every major laundering prosecution, there's a person, not just a paper trail. An accountant who kept records they weren't supposed to. An employee passed over for a promotion who decides the compliance department needs to see something. A shell company's registered agent who finally talks to investigators after years of quiet unease about exactly whose money they'd been moving. Whistleblower protections in many jurisdictions now include substantial financial rewards for insiders who report laundering schemes that lead to successful prosecutions and penalties. An incentive structure built specifically because internal cooperation cracks open networks that external investigation alone often can't reach. Someone who's actually seen the shell company structure or sat in the meetings where an executive decided not to ask an obvious question holds information that years of subpoenas might never fully reconstruct from outside. This is, in a strange way, the actual weak point in every method described above. Structuring, shell companies, real estate flips, offshore trusts, trade invoicing, crypto mixing, correspondent banking, every one of these methods can survive external forensic scrutiny for years. Almost none of them survive a single motivated insider deciding they're done staying quiet. Level 10. How it actually unravels. Every level of this system, from a duffel bag of cash to a correspondent banking relationship moving billions, eventually depends on the same vulnerability. Money that starts dirty has to explain itself at some point to some institution in some jurisdiction, and every explanation is a data point that outlives the transaction itself. Financial intelligence units, FinCEN in the United States, and equivalent agencies internationally, exist specifically to aggregate suspicious activity reports, currency transaction reports, and cross-border wire data into patterns no single bank or single country could ever see on its own. A shell company invoice looks unremarkable in isolation. The same invoice cross-referenced against 40 other transactions flagged by different banks in different countries over several years starts to reveal a structure that was always there, waiting for someone with access to enough of the pieces at once. Most major laundering prosecutions take years to build for exactly this reason. The individual steps are each, by design, unremarkable enough to survive scrutiny on their own. What eventually convicts the people running these operations isn't ever one transaction. It's the slow accumulation of every transaction across every level, laid out together in a single case file that finally shows the thing dirty money was always trying hardest to hide. A straight line, however long and however disguised, connecting exactly where it started to exactly where it ended up. There's a reason investigators describe laundering cases as some of the most labor-intensive in all of financial crime enforcement, often requiring years of subpoenas, international legal assistance requests, and forensic accounting just to reconstruct a single network's full structure. Every layer added by the launderer, every shell company, every offshore jurisdiction, every mixing service is specifically designed to multiply that labor for anyone trying to follow the money backward. The system doesn't fail because investigators lack the tools to eventually trace it. It fails when it fails because tracing it costs more time and resources than most cases are ever allocated before political pressure. A statute of limitations, or simple attrition, ends the investigation first. If this changed how you think about where dirty money actually goes, drop the next topic you want broken down in the comments.